Whatever you think you know about market cycles, forget it. What we are witnessing right now in the silver market is not a rally. It is not a breakout. It is a malfunction in the global financial matrix. When an asset like silver explodes through $110 an ounce with this level of violence, it isn't signaling that the metal is valuable. It is signaling that the currency measuring it is broken. This is the kind of wealth transfer event that happens once in a century, separating those who understand the architecture of money from those who are about to be crushed by it. The velocity of this move, 250% in the year, 50% in a single month, is not normal price discovery. It is a warning siren. And if you don't understand the mechanics of what is about to happen this Wednesday, you are walking blindfolded into a buzzsaw. Most people are staring at the price chart, mesmerized by the green candles, wondering if it's too late to buy. They are asking the wrong question. The right question is, why is the system buckling now? To understand the future of your portfolio, you have to look away from the shiny metal and look at the crumbling foundation beneath it, the US dollar. The dollar index has collapsed to a 4-month low, hovering around 97. This is the fuel. When the dollar dies, commodities fly. It is a mechanical relationship. For a buyer in Shanghai, Mumbai, or Munich, silver just went on sale because their currencies are holding up better than the greenback. This creates a feedback loop of global demand that feeds on itself, pushing prices higher, which generates headlines, which sucks in more capital, which breaks the dollar further. But there is a darker signal flashing on the dashboard, one that most retail investors miss until it's too late. The New York Federal Reserve has been making phone calls. They are reaching out to dealers to check on exchange rates, specifically the yen. In the high-stakes poker game of central banking, this is the equivalent of the house checking the security cameras. It suggests they are preparing for an intervention. They are terrified of a disorderly collapse. When the Fed starts checking positioning, it means the smart money is already repositioning for a shock. And with the yen rallying hard, the big institutional players are betting that the status quo is about to shatter. Add to this the geopolitical powder keg. We have threats of 100% tariffs, trade wars shifting fronts overnight, and a level of economic warfare that makes traditional forecasting impossible. In this environment, algorithms break, models fail. The market becomes a raw nerve, reacting to fear and greed in milliseconds. This brings us to the most critical event on the calendar, the Federal Reserve meeting ending Wednesday. Usually, we watch for interest rate cuts. This time, the drama is existential. There are whispers growing louder by the hour that the political independence of the Fed itself is on the chopping block. Imagine the chaos if, in the middle of a monetary policy meeting, the leadership of the central bank was challenged or replaced. That is not a policy pivot. That is a regime change. This crisis of confidence is why gold has quietly marched past $5,100. Gold is the stoic in the room. It is the stoic in the room. It is the steady hand, the asset of kings and central banks, absorbing capital with dignity. But silver is the manic genius. Silver is the lightning bolt that strikes the same spot twice and burns the house down. While gold moves with purpose, silver moves with hysteria. It is a smaller market, a tighter market, and when the herd tries to squeeze through the door all at once, the price doesn't just rise, it teleports. However, we must strip away the emotion and look at the cold, hard physics of supply and demand. Silver is no longer just money. It is the lifeblood of the modern world. It is the most conductive element on the periodic table. You cannot build the AI revolution. You cannot build the green energy grid. You cannot build the solar infrastructure of the future without silver. Industrial demand now consumes 60% of the supply. This is inelastic demand. A solar panel manufacturer cannot simply switch to copper. The physics don't work. They must buy silver at $50, at $100, or at $200. They have no choice. On the flip side, the supply is paralyzed. Most silver is a byproduct of mining lead, zinc, and copper. Miners do not dig for silver. They find it by accident while looking for other things. This means that even if the price of silver triples, supply cannot respond. You cannot just turn a dial and produce more. We have been in a structural deficit since 2018, and the hole is getting deeper. We are running out of above-ground stockpiles at the exact moment the world has decided to electrify everything. This is the fundamental floor under the price. But here is the danger. Here is the trap that will bankrupt the greedy. Because the silver market is so small a fraction of the size of the gold market is the playground of speculators. The volatility we are seeing, with prices swinging wildly in minutes, is a double-edged sword. When a market goes parabolic, it invites leverage. Traders borrow money to buy more, thinking the line only goes up. They feel like geniuses. Then, the inevitable happens. A margin hike, a rumor, a single large sell order. The price drops $15 in an afternoon. This is the shakeout. It is a violent, necessary cleansing of the market. The exchange raises margin requirements, forcing the leveraged traders to sell to cover their debts. Their selling drives the price down further, triggering more margin calls in a cascade of liquidation. The price collapses not because the value of silver has changed, but because the gamblers have been evicted. The wealth is transferred from the impatient hands of the leveraged speculator to the patient hands of the physical stacker. This is the game. If you are leveraged to the hilt right now, you are not an investor. You are a target. To survive the next 72 hours, you must decide who you are. Are you a trader or a stacker? A trader must respect the stop loss, must respect the volatility, and must understand that being right about the direction doesn't matter if you get liquidated on a pullback. A stacker plays a different game. The stacker sees a 20% drop not as a loss, but as a gifted chance to accumulate more ounces for the long haul. The stacker understands that the paper price is a distraction from the physical reality. You need to watch the signals that actually matter. Ignore the nominal price. Watch the spread between the spot price and the futures price. When the spot price trades higher than the futures, it means the market is screaming for physical metal right now. Watch the lease rates. If it becomes expensive to borrow silver, it means there's none left in the vaults. These are the tremors before the earthquake. We are standing at a precipice. The next few days could define the financial landscape for the next decade. If the Fed signals weakness, or if the political pressure on the central bank escalates, the flight from the dollar will accelerate. We could see a melt-up that defies logic. Inversely, a hawkish surprise could trigger that brutal washout we discussed. But the long-term trajectory is written in the supply deficits and the debt spiraling out of control. The market is about to test your psychology. It will try to scare you out of your position at the bottom and lure you into a trap at the top. The winners in this environment are not the ones with the fastest computers or the most leverage. The winners are the ones who can sit still while the world burns around them, secure in the knowledge that they hold the only asset that cannot be printed, devalued, or legislated away. The storm is here. Don't just watch it happen. Understand it.